Hello, what's up, guys? I'm back with a new video. So, today it's going to be more about restructuring and, if coming to the point, it's going to be about restructuring and about what's the stakeholders need and about different IFRS standards, like how will restructuring affect hedging or, how will it affect goodwill and all of that. So, it will involve some calculations, but I'm not going in depth because I assume that you already know. My main point of focus is to cover what investors want, and I'll cover the technical article also associated to that. So let's get started. Let me shift to the technical article screen first, which is covering about what investors want. So here we go. So, so this is it. I'll start from here. And while our question is not directly related to this, but let me just explain you guys because why not? Why not cover about what stakeholders want, what all stakeholders want? Because our question partly covers about investors. And although it's not like an extensive answer or something, but you should know about all this. Like maybe when you're reading, when you're like, maybe you're not able to figure out some terms or maybe some question specifically comes associated to it, you should know about what is it. So, additional performance measures. Basically, if I start with it, it's not our conventional performance measures that we use. Maybe net asset turnover, ROCE, gearing ratio, liquidity ratios, cash flow ratio, this cash cycle, operating cycle, inventory turnover, all of that. All of the basic ratios that we have used in the FR paper as well for analysis and all. This is not specific to that. This is something beyond that to give useful information for being able to understand the financial health of the firm more better. Okay, so for example, there is here they have given some examples in the supermarket sector. It is sector to sector. Okay, it is not something specific to one industry, it is sector to sector. So, like for like sales, often defined as year on year growth in sales from stores are open for more than 1 year. Okay, so this combination, this comparison of growth between retailers that have different strategies with regards to store expansion. Then underlying profit before tax, retail free cash flow, net debt. So a net debt is net debt can differ from company to company. Again, for supermarket sector, it is defined as cash equivalents less overdraft, borrowings, lease liability, and derivatives. Maybe it's because they are not their net they are more reliant on cash, we can say, and yeah, like cash transactions are very huge. Although in today's times, even card is very much used. Visa, I always use my Visa, whatever. But the main point of focus is that this is the definition of net debt there. And retail free cash flow is what? Defined as net cash generated from retail operations, less interest and tax paid, retail capital expenditure, lease payments. So, retail free cash flow, net cash generated from retail operations, less interest and tax paid. In retail, because supermarkets and all these come in retail sector only, like they are reaching to the end customer after they have bought from somewhere, wholesale and all that. So we can say that theirs is net cash generated from retail operations, less interest, less tax, less retail capital expenditure and lease payments. Retail capital expenditure can be their warehouses, their storage units, their, probably what can I think of? Supermarkets, I think, go downs or their trucks, whatever transport they use to get the things from wherever they get it from place to place, from supplier and all that. So all of this is retail capital expenditure, to make that establishment more. I'm not here to explain this, but mainly this is how it can be suited to the supermarket sector, to the retail sector. Okay, to be more generalistic. But see, can you see this is specific to the sector? It can be specific to the company as well. Whatever the company feels is very important to reflect the company cash flow status or performance status. For example, if there is very heavily reliant business, the business is very heavily reliant on heavy equipment and all, and it's of course very expensive. You would have to take lots of loans and all for that. Maybe your cash flows are not enough, even if you are a large company sometimes. And now, as a result, you have to showcase your gearing ratios. Okay, you would have to showcase your net debt. You would have to focus more on showing cash flow ratios, and it's not necessarily the operating cash cycle. It can even be more emphasis on liquidity ratio, more emphasis on quick ratio, and besides this, make up some own ratio. Maybe even EBITDA, earnings before interest, tax, depreciation, amortization, EBITDA by revenue, or EBITDA by net profit, or whatever you feel is, efficient enough for the investors to understand what the health is like. Basically, it's just that. So benefits is that of although it helps them to understand, it can help them to evaluate the business in the eyes of management. They can also get an important instrument for easier comparison of companies in the same as the market or economic area. To present a confusing or optimistic picture of their performance is one of the negative aspects. Of course, my net profit has fallen down very miserably, but I will still show my EBITDA. I will still show something which is not involving lots of costs. I'll show my gross profit margin. I'll show more emphasis there. Or I'll, probably show after my other income is included. I'll use that way. I'll show such figures only. So you are trying to misguide the investors, basically. There's nothing to think about it, you know, and other inconsistency in the basis of calculation, inaccurate classification of items, general lack of transparency. So you're not explaining the figures. How? Why are we using it? Last year your basis was different. Now why it is different? How can you use it as a comparable if it is different? Okay, you need to properly disclose why it has been used. This ratio has been provided emphasis for because of so and so condition. Because my company is very reliant on debt, or my company is very reliant on equity. I want to showcase how am I returning to my this investors, my stockholders. How much is my dividend cover? I want to show that. Or how much is my investment ratio? How am I utilizing their funds? So if you're not showing the basis and if you're not maintaining the consistency, that's it. There's no point of the ratio then. So it is going to be misguiding if you are going to do these things. So to this end, the European Union has launched guidelines that address the concept, description, and presentation of APMs. The main requirements are issuers should define the APM used, the basis of calculation, and give it meaningful label. APM should be reconciled to the financial statements. That means from where have you taken it? Note 1. Okay, it is there. Schedule 1. Here I'm showing the entire schedule. This is the depreciation. This is my cost. Then I got the depreciation from here, from this particular schedule, which is about property, plant, and equipment. Schedule is basically the entire calculation showing initial amount, then less accumulated depreciation, then the depreciation charge for the year, like that. So that's where I'm referencing it from. So all that reconciliation has to be, properly there so that they can navigate easily to the place, right? Anyone reading should be able to navigate to where they are going. They will not simply believe in a random figure you are presenting in the notes. Then APMs are presented outside financial statements should be displayed with less prominence. That, of course, because it's not coming from a fair source, maybe some random source. They can't rely on that. It has to be trustworthy. And issuer should provide comparatives for APMs and the definition and calculation of the APM should be consistent over time. Yes, if APM ceases to be used, the issuer should explain its removal and the reasons for the newly defined APM. So, of course, sometimes if you have paid off all the debt, okay, you have got enough cash flow in the firm, you have paid off all your debt, and your interest. Uh, Now you're like, okay, I don't have much debt. I don't want to show gearing ratio. Like, well, there's no point of it. Tell them, show them that this is the reason I have paid off all my debt in so and so time, and that's why I am not going to show this ratio anymore. I'm not going to show my net debt anymore. Simple. These guidelines may not be practical when the cost of providing this information outweighs the benefits. Companies presenting APMs will most likely incur both implementation and ongoing costs. Although most of the information required by the guidelines is already collected for internal management, it may not be in the format needed to satisfy the disclosure principles. So it's clearly understandable. Sometimes, if you have to get industry-based analysis, maybe you don't have the access to the industry figures. Maybe some keep it private. That is also one reason. And so you can't make a comparative analysis there as well. But at least the max you can do is to, at least provide some reliable information as to why the idea of this ratio came up. At least that should come up. It's not something that you're randomly creating on your own just to showcase to the investors. It should be like industry practice types, or at least it should be there in the financial ratios. It should have been used. So that is one thing. Then ESMA believes that the cost will not be significant because APM should generally not change over periods. Exactly. You're just like using the same, consistent. Therefore, ongoing costs are related almost exclusively to updating information for every reporting period. And ESMA believes that the application of these guidelines will improve understandability, relevance, and comparability of APMs. So, REST is an example of this thing, and it is better that you read it. But I'm here to explain you, so let's go ahead. So, underlying profit before tax excludes items recognized in profit or loss before tax, which, if included, could distort comparability between periods. To provide realization, they decided to, yeah, okay, fine. Determining which items are to be adjusted requires judgment in which group considers items which are significant either by virtue of their size or nature that are non-recurring. Underlying profit is not an IFRS accounting standards measure and is not directly comparable to other companies. Yeah, so see, it's not maybe it's specific to the company itself. That's why they are just doing it. Not like the regular ones like ROC, net asset turnover, this gearing ratio, liquidity ratio. It's not like that. So this is the showcase, non-lying redundancy, financial asset fair value movements, net expense from legal disputes, losses on property disposals, underlying profit before tax. So redundancy and closure primarily relate to the cost due to be paid on the future closure of all mini stores in train stations and airports. Financial asset fair value movements aim to relate to income or expenses, but which do not relate to underlying performance. They relate to income, asset or expense or financial that have been present in PNL. Okay, not expense from net expense from legal disputes relate to income less expenses in legal cases. The group has two outstanding legal disputes. Okay, it is relevant. They would want to know about the status if it's like quite it could pose a very high risk to the cash flows in the future, or if it is serious for the reputation of the company, right? Then profit on property disputes disposal relates to losses incurred on the sale of non-trading properties. Such losses are not related to ongoing operating. So again, it's not you're not these are not related to the business, ongoing business, day-to-day activities, or the main part of the business. So don't know. They are not on the sale of non-trading properties. Let's just go ahead. Let's see. The disclosure embodies many of the best practices identified by ESMA. A description of the APM is provided. Correct. Method of calculation has been shown. See, we have clearly, I could explain it easily to you guys. So, of course, it is very clearly shown to us and it is satisfactory. The APM has been reconciled to group's profit before tax in the financial statements. Yes, it has to be a point to be taken note of, and properly dollar, million, everything, all the units have been shown, well and good. Whatever is making easy for the user to understand. Comparative information has been provided, the calculation appears consistent year on year. Okay, so that means that if you find it too exceptionally high, or or suddenly there was nothing last year, this year it emerged. So auditors will pose questions, and more than auditors, it will be like, why was this suddenly included? It's a question, it's a skeptical thing. It's like, this was not there last year. Why it got included this year? They'll ask such questions. So it won't become comparable if it is too high. The amounts are too high. Exceptional loss or exceptional profit or something. Because it can be skeptical enough, it can lead to risks of inflation, of course. Inflation of profits through such measures. Right? So, for example, some users may wonder whether legal disputes are ongoing for this group. If these costs will be incurred year after year, what is the justification for excluding them from the APM? Correct. Why have you specifically included them in the APM alone and not in the profit and loss? Not in your regular operating margin? Why? Why are they? Is it a? That's what I'm trying to say. Is it exceptional? Is it one off? Or is it regular? This is a confusing thing here. It is ambiguous. We don't know the answer. So it is one question that they can pose. I explained one point of view where legal disputes can pose a lot of this thing to the cash flows. Even if it is one time, And it is good that they have shown. But the other point of view is also correct. Is it regularly happening? Is it year on year? Is it expected to increase? What is the status of the legal this thing provision? Have we created a of course we have created, but have we are we planning to keep it for the long term? We need to ask such questions. We need to be skeptical. Think from all aspects. As noted in the article, some users vary of the motivation behind APM disclosures in the reconciliation. Underlying profit before tax is substantially higher than group profit before tax. Is this APM providing useful information or presenting an over optimistic view? Clearly, you can see it is, a bit higher than group profit before tax. Okay, so this is also a this is also a question that can be posed. So this is one thing. Then environmental, social, ethical factors. They increasing this focus of the business model on the environment and society. Performance can be measured in many ways, and not all of these are financial. For example, Iceland, a frozen food supermarket, reports its percentage food waste as a proportion of total sales. Iceland also discusses its progress towards the reduction of food waste year on year and the initiatives used to distribute surplus food to charitable causes. Why APMs such as those are of interest? Because reducing food waste will reduce a company's carbon footprint, and a company's success here may attract green customers and investors. Reducing waste will keep selling prices low, and which is important today's times of high inflation, of course. Yeah. So lower the waste, lower your costs, operation costs, and production costs and all that, and so financially it will impact that way, and lower cost will improve profits and cash flow, of course. Yeah. But more importantly, the reputation, and it does not necessarily have to be a quantitative information; it can be a qualitative information also, right? But now how you measure it depends on you. What ratio do you provide it? Do you provide carbon footprint, or as per industry standards, make up some, you get some formula for finding out the carbon footprint and how much it has reduced. You provide a proper basis for that. Even you can even hire an expert for finding out such things, because there is this environmental accounting very popular in today's time. So such things are there, right? We can consider. So financial statement users are demanding different types of information, and yes, hopefully calculations are useful. Only then these are relevant. Otherwise, don't don't disturb us. Don't show us. Now, giving investors what they need. This is specific to capital structure, but it's not that hard. Just read it, guys. Read it with me, guys. Let's do it together, guys. So, insufficient financial capital can cause liquidity problems. Sufficiency of financial capital is essential for growth. Discussion of management of financial capital is normally linked with entities that are subject to external capital requirements, but is equally important to those entities which do not have regulatory obligations. Financial capital is defined in various ways. The term has no accepted definition, having been interpreted as equity held by shareholders or equity plus debt capital, including finance leases. This can obviously affect the way in which capital is measured, which has an impact on return on capital employed. Some people say finance leases are also part of the capital. I have personally seen such financial statements. Some companies say no, only long term borrowings and short term borrowings, and some current liabilities, and some share capital that they have issued. So I have seen both types in questions. It really depends on what is the requirement that is given to you, right? All of this makes the word capital very ambiguous. We keep wondering, what is this? What does any user, random user who will come and read the financial statements will be like, what does capital consist of? That has to be disclosed properly, or at least notes. They have to be presented. Which note number is that particular capital given, right? And while comparing with other companies, also they should consider that okay, that company considers capital as something else. They have some extra thing in it, maybe even overdraft. This company only has debt in the capital. They don't even consider equity. So this is such thing that you have to consider the definition of capital in different firms. So that's why this is a thing. So investors have specific but different needs for information about capital depending upon their approach to the valuation. If the valuation approach is based upon dividend model, then shortage of capital may have an impact upon future dividends. Of course, DVM model involves using dividends also in the calculation and the growth and all that they find out. Okay, so if they see that okay, their cash flows, there is shortage of capital, that dividend model clearly means you are valuing the business. The whole point of the business is giving dividends. You're valuing the business based on that. So if you don't have enough capital itself, enough cash itself, enough amount, enough funds itself, whether it's debt also doesn't matter. Any funds to give out the dividends, clearly you don't have enough. You are not. You can't. Investors won't find you a good one for investment, right? If they are not growth perspective investors, if they don't want you for the long term, if they don't see you in the long term, they don't prefer in long term profits or long term gains or whatever, and if they prefer dividends, clearly they are not going to prefer you if you are not going to give them dividends. In short, so they will care about the capital that you have got. ROC is for comparing the performance of entities, and investors need to know the nature and quantity of the historical capital employed in the business. There's diversity in practice as to what different companies see as capital and how it is managed. They want to know the purpose of your capital. If investors want dividends, that will become the purpose of your capital. If they rather prefer something for the longer term, they they probably won't look at dividends. Of course, what I just said, they will look at other issues. Probably your ROI or your what we say, uh, how much do you sustain, how well can you sustain for the longer term. So even ROC is one of them. So this is the thing, they look at your cash operating cycle also, they'll also look at short term liquidities, and they'll also look at your long term debt. There's a lot of things that they will look at, but this is the point. What they see as the purpose for the capital is what matters to us. So there are various requirements for entities to disclose information about capital. In drafting IFRS 7, they consider whether it would require disclosures about capital. In assessing the risk profile of an entity, the management level of entity's capital is an important consideration. So when you investigate about a company before investing, it is basically telling you that you look at how the management is handling the business and the operations, what type of people are there, how is their, you know, all of that character checks and how are their skills, qualification, whatever. But at the same time, you also see how well the capital is used and where it is used. Is it aligning with your preference? Which is why that disclosure is important. So, as per IFRS 7, so the board believes that disclosures about capital are useful for all entities, but they are all not intended to replace disclosures required by regulators, as the reasons for disclosures may differ from those of the board. As an entity's capital does not relate solely to financial instruments, the board has included these disclosures in IAS 1 rather than IFRS 7. Correct. So IFRS 7 requires some specific disclosures about financial liabilities. It does not have similar requirements for equity instruments. And so we already know this. There are a lot of repayments in your 25-year-old loan, and you want to, this year the one repayment is there that will come in your current loan status, and you will show the classification, the disclosures, and then you'll also show how you're managing your credit, your schedule of payments, your what we say, all of this will be, like properly shown. And this is specifically covered in IFRS 7. And what the board has done is whatever disclosures of such kind, how the capital is used, what the capital structure is, what is the purpose of it, and all that, that is all transferred to IS1 presentation. There it is covered extensively in disclosures as per IS1. That's all it's saying. So the board believes that disclosures about capital are useful for all entity, but they are not intended to replace disclosures required by regulators, as the reasons for disclosures may differ from those of the board. Yeah, I'm just reading the same thing. Yeah. Basically, it's trying to say the board considered whether the definition of capital is different from uh, definition of equity in IS 32. Okay, so it's trying to say that your definition see, equity consists of various components, like share capital, NCI, retained earnings, group retained earnings, whatever, and dividends also. But like that's a like retained earnings minus dividends, whatever it is. My point is, it can also consist of some reserves, right? There's a share premium reserve, revaluation reserve, cash flow hedge reserve, and all that. So it's saying that it might look like equity, it might meet the definition of equity. You are having an obligation to pay, but it might not exactly meet the definition. It might not be a part of the capital. You can't consider reserves, the cash flow hedge reserve, as part of your capital. You can't consider subordinated debts as part of your capital. Debts are debts, they are liabilities. They meet the definition of that completely. They don't meet the definition of a capital. So even if preference shares, for example, come under your equity, that doesn't mean it's a part of the capital. Something that they have given an example for. They have given the example of cash flow hedge. So we know how it is treated, gains and losses in OCI, and then that goes to the cash flow hedge reserve, which gets reclassified once the transaction takes place in the future, right? Because it's for hedging some transaction that will take place in the future. So once that takes place, you will reclassify that from the revaluation, that cash flow hedge reserve. You'll remove that cash flow hedge reserve. But any which ways, whether it is removed or not, it's not part of your capital. It's not giving you funds. It's just some hypothetical scenario types, which is where you're recording the fair value gains and losses. It's some related to some derivative. So it can't be regarded as capital. So you need to be very specific about your elements, be very granular about what is included in equity specifically, what is included in your debt specifically. Maybe you don't recognize you don't recognize your lease liabilities when you find out your gearing ratio or when you find out your capital, right? So that is one thing. Next is IS1 disclosures about this same. Requires an entity to disclose information that enables users to evaluate the entity's objective policies and processing for managing capital. The objective is obtained by disclosing qualitative quantitative data, should include narrative information, what company manages, how the company manages, whether there are external capital requirements, and how those requirements are incorporated into management of capital. Yes. External capital requirements, no, just basically explain your capital structure. That's it. That's all it's covering. So extensively in detail, it is covering about that, much more detail than IFRS 9, IFRS 7. IFRS 7, actually, because that covers about presentation of financial instruments. So some entities regard some financial liabilities as part of capital, while other entities regard capital as excluding some components of equity. For example, those arising from cash flow hedges that I just said, the revaluation reserve, the cash flow hedge reserve, all of that. So the board decided not to require a quantitative disclosure of externally imposed capital requirements, but rather decided that there should be disclosure whether the entry is compiled with any external capital requirements, and if not, the consequences of non-compliance. So further, there is no requirement to disclose capital targets set with the management and whether the entity has compiled with those targets or the consequence of any non-compliance. Okay. So sometimes you have, certain things, covenants, right? External, when you take from bank some loan or something, you have some covenants to disclose and all that. And investors would be interested to know about what is the status. So it's specifically talking about that. Internally, maybe you are just doing it for performance purpose, but externally, external capital requirements, you want them, the banks also, the users of the financial statements, to see what is the status of the firm, how well they are meeting their covenants, right? And you are referencing also the notes, and also that is one thing about it. Next, examples of some of the disclosures made by entities include information as to how GRE is managed, how capital is managed to sustain future product development, and how ratios are used to evaluate the appropriateness of its capital structure. An entity bases these disclosures on the information provided internally to keep management personal. If the entity operates a separate jurisdiction with different external capital requirements, such as an aggregate with disclosure of capital would not provide, the entity may disclose separate information for such separate capital requirement. Yeah, so for each separate capital requirement. So if they feel that one specific section is not entirely covering about it, they'll prepare specific subsections for each capital external capital requirements, because it's that important. Besides the requirements of IS1 IFRS practice one, such as that the management should include forward-looking information in the commentary when it is aware of trends, uncertainties, or other factors that could affect the entity's capital resources. right? So it is talking about that. This is like reading and understanding. It's nothing huge. Uh, Now, additionally, some jurisdictions, but by capital resources, again, no ambiguity. Specific to the capital, it's more permanent parts of equity. Your share issue, your retained earnings, profits. We are interested in that. Where our capital is coming from, right? So then it's about Companies Act. Additionally, some jurisdictions refer to capital disclosures as part of their legal requirements. In the UK, Section 414 of the Companies deals with the contents of strategic report and requires a balanced and comprehensive analysis of the development and performance of the business during the period and the position of the company at the end of the period. Right. So, comparative analysis with the previous year, which is properly, even following the same accounting policy as well, that is another area. But what I mean to say is, your accounting policy should also be similar. It should not, if you require that, actually, it's not a if, it's a requirement. You have to restate your opening retained earnings and your previous figures if accounting policy has changed. So it has to be comparable. By comparable, seriously take it as comparable. The component should be same to same in both the years. This section further requires that to extend for understanding the development, performance, or position of the business, a strategy report should include an analysis using key performance indicators. It makes sense that any analysis of a company's financial position should include consideration of how much capital it has and its sufficiency for the company's needs. Financial Reporting Council guidance on the strategy report says that comments should appear in the report on the entity's financing arrangements, such as changes in net debt or the financing of long-term liabilities. So, how are they planning to, what are their components? What are their components? What are their arrangements for meeting their long term obligations? How much cash flow they have? How much overdraft they have? What is their finance cost? Everything matters. Every single thing matters. They want that to be properly included in the management commentary, in the reports that are submitted to investors, and whichever analysis reports we are giving. So, such things are important. Next, in addition to the annual report, investors may find details of the entity's capital structure, where the entity is involved in a transaction such as sale of bonds or equities. It is normal for an equity to produce a capitalization table in a prospectus showing the effects of the transactions on the capital structure. The table shows the ownership and debt interests in the entity, but may also show potential funding sources and the effect of any public offerings. Sometimes dilution takes place, right? Dilution will take place. This will be the pros and cons. You are not going for a share issue because already investors are not giving a go ahead with that for that. So they are instead, or you have already gone for one public offering. You feel it's enough. Now you should not dilute the ownership anymore. Okay, so for that purpose, maybe investors won't be happy, or you won't have enough dividends to pay, or something like that can make repercussions. But my point of focus is, instead, maybe go for debt. Maybe you should go for debt and such situation, or your cash flows are at a problem. You are at a liquidation risk. You have to go and use the equity resource because you don't have enough funds to pay your interest, and so that's pretty much it. You're just trying to show in the capitalization table what is your risks, benefits, potential funding sources, which bank is ready to give you based on your credibility status. Basically, an honest report about what funding sources you can take. The capitalization table may represent the pro forma impact of events that will occur as a result of offerings such as automatic conversion of preferred stock, the issuance of common stock, or the use of offering proceeds for the repayment of debt or other purposes. The board does not require such a table to be disclosed, but is often required by securities regulators. Yeah, sometimes what is the effect of your rights issue? You know, we calculate the figure also with that fraction, theoretical exercise price. Then we find out what will be the price, what will be the EPS, what will be the effect, basically, is what they want to know. So that is one thing about capitalization. Just for extra information, you should know about the industry. It can seem that information regarding the entity's capital structure is spread across several documents, including the management committee, the notes to financial statements, the interim accounts, and any documents required by securities regulators. Yeah. Interim accounts are nothing. It's just before the financial statements are like, properly. It's like a draft financial statements, or at some specific time before the year end, auditors ask for interim accounts and all that, uh, to make the interim audit, to understand about the business and all. So it's just basically that. So in that also, of course, you need to make a disclosure, because it will take a lot of time for the company to, give its final financial statements approved, issued properly, where auditors have done their work and all of that, and finally it is issued, and it's properly signet all the signatures are there, everything is done and dusted. So after that only you'll get. So that's why interim is where we usually rely on. So debt and equity, essentially the approved class of capital reported in financial statements, debt and equity, but different levels of benefits or risks are there, as preference shares are there, debentures are there, bonds are there, different levels of risk are there. You will have to hold it for different periods. There will be different interest rates for them. Equity shares also, different classes are there. And sometimes you have convertible also. At one point there will be debt, at another point there will be equity when it is converted. So this is the thing. So when an entity issues a financial instrument, it has to determine its classification either as debt or equity. The result of the classification can have a significant effect on the entity's reported results. Exactly. Liability classification impacts upon entities' gearing ratios and results in any payments being treated as interest and charges charged to earnings. Equity classification may be seen as diluting existing equity interest, of course. So IAS 32 sets out the nature of the classification process, but the standard is principle based and sometimes the outcomes are surprising to users. IAS 32 does not look to the legal form but focus on contractual obligations. Yes. So, the variety of instruments issued by entities make this classification difficult with the application of the principles, occasionally resulting in instruments as seen like equity being accounted for as liabilities. Recent developments in the types issued. So, basically, it's trying to say, then, for example, it's just basically saying it's surprising in such cases, some cases where equity is classified as liability and something that means liability depreciation class is classified as equity. For example, preference shares. We have the term shares used, but they are redeemable. They can be irredeemable also, they can be redeemable also. There are two categories under that also. So if it is shares, if you're issuing, but at the same time there's an obligation that is coming up which makes it a liability. If you're paying dividends on it, technically it charges an interest in the PNL. So all of this is very different from how equity is. Equity, we have dividends on it, we don't have interest at all. Dividends are also discretionary. Maybe sometimes investors sit and decide on that in a different period, before the financial statements, before all the year end all takes place, and then afterwards it is basically paid after all this profit after tax and all is found out and all that. And from there we'll find out what will be the net effect on the retained earnings after the dividends are paid. But here it is different. Here, before profit before tax only, we'll get the interest in preference shares. So it is confusing. And other cases, perpetual bonds. Here you are, you are issuing bonds, but they can be irredeemable. So they meet the definition of an equity, and they'll be classified under equity. There will be dividends also under it again. So basically, that will also be regarded. That also again meets the definition of equity, but the word bonds make it confusing, because that's the thing. It's just not about this word share and bonds. It's about the criteria. It's about the definition. It's about, as IS 32 says, the substance of the financial instrument. If it does not meet the definition, also it doesn't matter. It's a substance that matters. Yeah, redeemable, irredeemable, issued. How is it like? So that's about it. So there is a diversity of thinking about capital, which is not surprising given the issues with defining equity, the difficulty in locating resources of information about capital, and the diversity of business models. Capital needs are very specific to the business and are influenced by many factors: debt governance, preservation of debt ratings, a variety and inconsistency of capital disclosure is not the decision-making process of investors. Therefore, the details underlying a capital structure are essential to the assessment of any potential change in entities' financial flexibility and value. Definitely, because it decides about your going concern status as well, so it is directly correlated to that. And generally it's very important. Next heading to go for would be which one? Understanding the business model. So again, I'll cover this article. I don't mind because we are here to study. Your exams are coming up soon, guys. So no excuses while doing this. And this is to stay for your longer term, man. This is not for short term purpose. It's for your long term. You will learn about SBR for life. You will be an accountant or something in the financial reporting industry or something. You should know about all this in bits and pieces, everything about it. So I'm not going to stop. You go stop, but I'm not going to stop. So understanding the business model of an entity is helpful in analyzing and communicating the essence of a business and for predicting the implications of change in circumstance. Yes, now it is about analysis of a business model. Now, this is not specifically capital structure, but can be capital structure because that's very important while while a business is there with us. The business model in the context of integrated reporting is the company's system of transforming inputs, our capital, through its business activities, including into its outputs and outcomes that aim to fulfill the organization's strategic purpose and create value over the short medium term. And the definition may seem quite theoretical, but there are a number of entities who use this definition to disclose the resources, also known as capital, that the organization draws on as inputs to its business activities, how they are converted. What is the nature of the business is what it's talking about, right? So, how it is adapting to the different changes happening in the business, happening in the industry, what changes are there in the inputs, what capital resources you're taking up, any extra, any less extra, uh, in the availability, quality, and affordability of inputs, how these changes can affect the organizations. For example, you're in the verge of bankruptcy, you can't take up debt, no bank will give you, your investors won't be happy with you, or you are not having enough cash flows, your dividends, you are not ready to pay dividends, again that will affect the way you see capital, you won't be able to take equity and all that. So this is common sense, you should know by now, right? So business model information can be fundamental to investor analysis, provide context and understanding and the other information to the other information in the annual report. The provision of business model information can demonstrate entities' understanding of the business and key drivers, which can create investors' trust and reduce risk. Additionally, investors need to understand the business, how the business has performed, and how this performance has been affected by various factors. There is an argument that the information regarding the business model should be presented outside of the financial statements, like management commentary. Clearly, it's outside of financial statements and all. And it is usually issued on a monthly basis or something, there's a particular regular intervals. Financial statements are only like once or twice in the year, interim and final. Yeah. So investors will need to know how the business model is responding to market trends and how the strategy supports the key components of the business model. They will wish to know how management considers risk and opportunity across the business model and how money is made and value generated and redistributed. Investors will look at key performance indicators and how they reflect. See, basically, basically, it's trying to say that what is a strategy that it's following, what is our business strategy, what is the nature of the business about, how we are overcoming any going concern issues or something, how we are getting our capital, what are we doing, what measures are we taking for that, is just covering that. Okay. Let's go ahead with it. It's pretty understandable. It's nothing, no rocket science. So there's been discussion to whether business model should be considered in standard setting and in particular whether its term should be defined in the conceptual framework. The ISB decided not to define the business model in the conceptual. However, the term has been implicit in IFRS for a while. For example, IS2 requires inventories to be measured lower of cost. IS2 includes an exception that allows commodity trade to measure the inventory at fair value less cost with changes in fair value less cost recognized in P&L. And yes, so basically, uh, basically it's trying to say. So basically, it's trying to say whether a particular IFRS standard, any, in IS1 or something, presentation or something, it should be covered, or in the conceptual framework, it should be covered or not. So what I mean to say here is, what they're trying to say here is through the current IFRS standards also, they are reflecting the business model. For example, if you're a trader, you're trading cryptocurrencies, as I explained in the previous video, please do check, like and subscribe and share. And I've also covered that in the Insta reel. Yeah, that's it. So if you're trading cryptocurrencies, or if you're having stock, your business is about stocks and you're regularly trading them, your inventories are basically stocks, of course, shares and all that. But you're not going to value it at lower of cost or NRV. You're regularly trading it. You're buying and selling and buying and selling and buying and selling, and whatever you're gaining out of it is what is going in your profit, right? Net profit. So that means you will have to consider it as a part of uh, your inventories, but you would have to value it at fair value less cost to sell and with gains and losses going in P&L. Because of course, what will be the gross profit? What will be the operating profit there? What will be the costs there? What will be your gains and losses there? Of course, these are the most relevant ones. So already business model is depicted in your IFRS standards. Then IFRS 9 requires classification and measurement of financial based on entity's business model. Although IFRS does not contain a definition of the term business model, it includes some implicit assumptions about its meaning, views the business as based upon how the entity's assets and liabilities are managed. So, so it means that how the entity's assets and liabilities, their what we say, uh, for example, certain times you're maybe a supermarket and you have got lots of current liabilities in the form of payables, uh, or not supermarket. Let's consider your payables. You are selling heavy equipment and all, and you're very reliant. Your liabilities, maybe they are quite long term. People will pay you after a lot of time because they are quite, the goods and all are quite expensive. They'll pay you after a lot of time, so that will be a part of your current liabilities. Lot of time means 4, 5 months or 12 months also, within the 12-month period only, but quite a lot of time, quite a lot of months. That will be a part of your current liabilities. But you will still consider it when you find your debt ratio, your gearing ratio. So that is where your business nature is relevant to your IFRS 9. Or this is not IFRS 9 specific, but maybe sometimes the way your assets are measured. Another example I can give is your valuation method, your what do we say, your investments. If it is for the long term or the short term. If your business is about trading, of course, fair value through P&L. And if it's for about that other thing, if you have a debt instrument, it's for long term, fair value through OCI or amortized cost, whatever you feel is more relevant. So it is considering the business model test there, right? Business model test, cash flow characteristics, and all that. So my point is that your business model is reflected every IFRS standard. So it states that entity should classify financial assets as subsequently measured or either amortized cost or fair value on the basis of both the entity's business model for managing the financial assets and the contractual cash flow. Yeah, okay. So it's just basically defining what is it. By manufacturer are likely to fall within the hold to connect business if the trade receivables do not contain a significant financing component in accordance with IFRS 15. So hold to collect business model. So basically, maybe if they pay in the future, if the customers are paying in the future, the cash flows are likely to come up in the future. You're going to discount it. You're going to include a discount. Of course, time value of money. You already know that. It's simple. Then, if it's saying that you're not going to regard it. If you're a manufacturer, you're of course having trade receivables for the long term. You will hold assets. You will hold those trade receivables for the long term, right? And of course, you don't, if you hold it for the long term, you will have to classify it under amortized cost probably, and you, you're not going to trade for it, of course, and you're not going to sell it either. Of course, if you're not going for a, what we say, sale of account receivable to the bank or whatever, so you're not going to sell it either. So you're holding to collect. Hold to collect means you are holding it for the long term and then you're going to collect it. So clearly, it meets the definition of a business model and a cash flow characteristics test, right? And it does not necessarily have to be loan. It does not necessarily have to be interest, as we are taught in the normal debt instruments. Thing. This is specific to the agreed payments as per the contract. So you're going to hold to sell model is basically maybe classifying receivables under amortization cost model, calculating it according to that. So I'm just going to say this about it. Uh, then a debt instrument is classified as subsequently measured at fair value through OCI under IFRS 9 if it meets a hold to collect and sell business model test. The asset is held within a business model. Yes, see. So IFRS 9 fair value through OCI. You're going to sell it in the long term, right? It's both hold to collect and sell. But receivables are not hold to collect and sell. It's just hold to collect. So that's the thing about it. So the business model typically involves greater frequency and volume of sales than the hold to collect business model. Integral of the business model is an intention to sell the instrument before the investment matures. Yeah, that's you're going to keep it for the long term, and yeah. So and then you're going to sell it. Here in our case, you're in receivables case, you're going to keep it up to the time till the agreed payment term or whatever. So fair value through PN is a residual category to hold the financial asset for trading. Subsidies requirements for equity and IFRS could discourage long-term investment. Their view is that the default requirement to measure those investments at fair value with value changes recognized in PNL may not reflect the business model of long-term investors. So sometimes, you're investing in SIPs. I'm also not SIPs. Okay, in in a particular industry for a long term, and you want to maintain the changes happening in the PNL itself. So they're not happy with this inconsistency in the measure. They're like, why our changes, our fair value changes can't be regarded in PNL? Why do we have to follow OCI and all that? So this is one complaint on their part. Yeah, so the term business model has also been used in other standards. IFRS 8 operating segments defines an operating segment as a component of equity that engages in business activities from which it can earn revenue and incur expenses. An entity with more than one business model is likely to have different segments. If an entity has a business, it will have an internal reporting information which measures the performance of the business model, which may in fact be the business segments. So segment by segment, what are the business models separately talking about their inputs, their inventory, their capital structure, their strategies. That's the thing about it. Then IS 40 investment property distinguishes a property that is held by entities for investment purposes from the one that is intended to be occupied by the owner. Investment property differs from an owner occupied property because investment property generates cash flows largely independently of the other assets. IS 40 sets out so Yes, so basically it's saying that any gains and losses associated to it, it's very different from the other assets, right? This is that is held by entity for investment from that is intended to occupied by the owner. Arey yaar. Yeah. So IS 40, now this IS 40 paragraph is covering about this. IS 40 sets out the two main uses of property, owner-occupied investment, which implicitly correspond to different business models. Owner-occupied property should be measured at depreciated cost as impairment, which is a property reflecting the user, whereas investment is measured after in the statement on, yeah. So basically, it's saying that if the investment property, again, here it has reflected the business model. You have ownership, owner occupied, so it should be cost less impairment. You have investment purposes where fair value changes take place. You are gaining from the trading. Again, you will record in P&L, just like our this equity investments for short term or something. So, if the business model continues to play a significant role in standard setting, it would give insight to how an entity's business activities are managed and help users assess the resource and liabilities of the entity. So, some guidance can be provided. Maybe a conceptual framework telling about how it is, possibly what is a concept surrounding it. Alternatively, we can argue that this approach may reduce comparability as it could result in different classifications, reducing this may introduce bias in the way financial statements are reported, therefore make comparisons between entities difficult because different people, different businesses, different entities will regard the liability, the business, what we say, the business model concept in different ways. Maybe they won't regard it. Of course, their interpretation to interpretation, to business to business, nature to nature, different ways of finding out assets, different ways of finding out liabilities, as I covered in APM's topic. So, why would they follow a consistent model with others? Definitely, there are going to be comparability issues. So, this approach can make financial statements and the same industry more comparable. So, yeah, while this can make this thing happen, thus the difficulties with the definition of the business and its consistent application should not constitute a reason for excluding it because it has relevance in terms of financial decision making. needs of the users, and at the same time they can even compare with different businesses. So that is one thing about it. And so although the business model concept first appeared in IFRS 9, there has been an implicit use of this concept in IFRS accounting and for a long time, and that's pretty much it. So it is not only covering about the outside, it is also covering about the inside. It's covering about every aspect, macro, micro, every single aspect of the organization, and is also extensively covered in integrated reporting topic, which you should know. Comes in SBL, and it should generally be, all the financial statements, your strategies, your over the period, your evolution, history of the business, comparability with competitors, compatibility in the industry standards. Everything is covered in the integrated report. It's like everything, all pervasive, right? So that is how, even it's saying that that's how in the IFRS standard, or there should be an IFRS standard setting, or even a conceptual framework associated to it. Uh, there should be a conceptual framework associated to it that can make it very, at least in the industry, it can make it very useful, very relevant, and some guidance can be provided, and people will take it more seriously, and stuff like that. Yeah. So let's go to our question. Yes. How about have I already got the question? Because for presentation purposes, I prefer showing you guys in split screen. So please try to understand. Uh, so I'll just save it. Give me a second, guys. So let's get started. Let's read it. I'll read through and help you answer the question generally based on the IFRS standards and all. So, from was acquired on 20 October. Stencil will itself be restructured and will take over the restaurant. Board of actually approved the restructuring plan on 20 October. After it had discussed and received approval for the plan, restructuring involves material changes. On 1 November, the formal plan and termination benefits were discussed in a meeting of the affected employees. On 3 November, issued press release which summarized the plans and the fact that a number of restaurants were going to close, resulting in the loss of employment. This attracted huge publicity. Based on the questions, I can see that you need to identify when a constructive obligation was created, and which all dates it was not created also. So this one all you will cover from here. So when the formal plan was made and when it was announced, there are differences in these dates. So when it was announced to the people, to the employees, because it has to be announced to the relevant relevant people who have been affected by the loss. So let's check. Anjali issued a press release. This attracted huge publicity. Okay, not even 3 November. 10 December, binding contacts to purchase new head office. No, 1 November is when they actually did it. I'm sorry, I just overlooked it. I'm very tired. I've made a lot of content today. So, the formal plan and termination were discussed in meeting of the affected employees. This is when exactly the provision should be created for the restructuring. Then the press release took place and all that, and that is what basically the creation of formal plan itself creates an obligation. So it's like you're creating an obligation as a result of past event, that is the restructuring event, the decision of the restructuring. And now that the obligation is created, you have to take steps over it, you have to implement, and it has to be as soon as possible. This thing has to start like now. That's how it is. So this is what it. These all things you have to mention. 20 October it was announced, and 1 November. Yeah, 1 November it was discussed. So well and good. That is the day when we are doing it, and general public also estimated expense. So basically, it's saying that I have just made some jot down some points. You have to make some estimations. You have to make some estimations about the number of employees and all, which is there in the second part of the exhibit. I already read it. Second exhibit of this question. This is part C, question 2. So this is it, and 5 marks means 5 solid points, not some small points which I've written. And yeah, so your plan should cover your sorry provision should consider the uh, estimate of number of employees, the expenditure. So what are the events, yeah, so it discusses what are the events that create the obligation, the businesses, the restaurants being closed, the press release, number of employees, sorry, we specify to the employees about the plan, about the restructuring thing, about this decision. And at the same time, you should also consider these facts and then make up the provision. So locations, jotting down, closing down, dismantling, whatever is involved, all of that should be included, relevant to this thing, whatever is involved, restructuring to this. But beware, relocation of employees to different locations, to new locations, won't be included. That's not a part of this, because that is as a result of restructuring, but that is as a result of restructuring, not exactly restructuring part. So whatever costs are involved specific to the restructuring thing is what is involved here. So this is about it. And then general public, estimated expenditures, whatever it is. Then explain how the restructuring cost should be measured and recognized in the financial statements, and you are asked to explain implications of goodwill relating to acquisition of stencil. So this is simple. How the restructuring, uh, see, basically it is saying measurement and recognition criteria. So how are you going to measure it? Like, you will include all the relevant costs. But whatever I just explained, my point is not that I don't want to make it that long. So whatever I just explained, future operating losses, relocation, training, all of this is aftermath, not in the restructuring provision. So don't consider that, specifically write that as per the standard. And what is relevant is the number of employees. And I have just read that certain number of people, what we say, December was expected to be completed and no significant, yeah. So at 31 December, the year end, it was expected, the restructuring was expected to be completed by March 2009 with no significant change. So one more criteria that is important for recognition is that it is not likely to change. It is likely to take place and as per the plan. So make it as much, the estimate should be as actual as possible, as accurate as possible. So the number of employees and all, at least that should be like pretty evident by the time this is announced to the people, and within the weeks it is announced. So that is about it. And so this is just to confuse you. They include such costs as retraining, relocating, and future operating. And they plan to recognize the provision for the cost of restructuring in the consolidator as other. Okay. So that is a different question. Although they should not, they are okay. They are planning to recognize as a provision for restructuring stencil. That is good, because that is relevant to stencil. But in the goodwill, it should not be recognized. There's another question covering about the goodwill. Okay. So my point is not to cover all this. My point is to explain you how it is being done. For recognition also, as I said already, this there has to be past event and all that. Whatever past events, be relevant to the question, make it specific to the question. Restructuring planned after acquisition. So basically, the question was that goodwill, how is goodwill going to be, if there's any implications. So since, if you see, it was acquired on 20 October, and post that, this they have actually started to implement the plan in late December by reorganizing stencil. So that means they have started it later. So at that date, even if, see, it has, you don't get confused by these events. It has been informed to the employees of Anchali, okay, like their existing business, not to stencil. So stencil they might have informed later, and they might have like, of course, implemented the plan and all. See, the thing is created only when plan is starting to be implemented. Okay. So in others cases, clearly they're saying, they are mentioning the word late. In other businesses, it started earlier, and that is why their provisions are created earlier. In Stencil's case, even if there was an obligation created, maybe they might have announced, employees might have, all of that is not extensively measured, but it is understandable. Their implementation of the plan started pretty late. So we can say that 20 October was a date of acquisition, but there was no such obligation on that particular date. That's all I can say about it. So if there are any relevant costs, even if like something specific, or maybe they might have started in minimalistic terms. If there are any costs associated to that, or uh, we won't really charge it at that point, because the plan was actually implemented as on December. So that's when we are going to recognize it. Then what is the next part? Discuss why it's important that they should communicate restructured. Yes. So my main point is, yeah, my main point is to cover about this part. That's why I spent the entire hour and all explaining about the technical articles, because I want to mention about this. So why it is important that they should communicate the restructure to investors? It's a common sense based question, honestly speaking. But there has to be 5 points with with 2 marks for some professional marks and all that, professional this thing, clarity, quality of discussion. So it's not just merely common sense, you'll write some random thing here and all, like it's not a conversation going on, it's proper, relevant to the scenario, why it's important to you, why do you think, logical points, why do you think it is important. So basically, they, now this is restructuring, they would be concerned with why it has increased, why the costs might have increased, why was restructuring even done in the first place. They would firstly ask for a report on that. Okay, what have been the impact about that, what are the benefits, what are the risks associated with that in the long term. Based on all that reports, all those concerns addressed, evidences, they will go and decide whether they want to invest in the company, they want to stay with the company or not. Secondly, since these restaurants will be shut down, their associated buildings and something will be affected, there will be some environmental impact also, probably. We can assume that, we can imagine all these scenarios, probably there might be. So you can cover about this also, the risks associated to sustainability, and the investors, ethical investors would be concerned about that. And secondly, we can say, yeah, so that's what I've written here: projections of financial information, estimations, long term, short term, and communication, major impact on revenues, profitability, costs, because of course they are investors, they'll be concerned with whether dividends will be paid to them, whether they have enough profits for that, or whether they are looking for long term growth and where they have enough money to give them long term gains or not, right? So that is one point. And then also they will be concerned about the point whether employees have been taken on board while taking the decision of restructuring. They will be concerned about that, because again, ethical investors, they'll be believe in ethics, they'll believe in the fact whether there was a formal plan in place, and they will ask for the minutes of the meeting with the employees, when when we might have discussed about the plan with them. So such things, will the granular details about ethics is what they'll be concerned about. And yeah, so we can cover about that. And then it is about the calculations part, so that is pretty clear, because that's just basically how many, based on how many employees will stay, how many will leave, and how much they are they're likely to get if they probably stay, or if they leave beforehand. It's just varying based on that scenario. I'm not here to cover that, I'm here to cover the ethics part. So that's all about it, guys. Hope you like this video. Please, there's a lot of time spent on it, because I genuinely want to help you guys figure this out. In case if you think that this is not that important, you can't, you know, it's a different topic. It's a very different topic. Cryptocurrency and these are very different things. So these might not be relevant to the syllabus, or these might be overlooked many times. So your point is to go and consider such scenarios and be efficient enough while answering them. So why to simply lose 5 marks? Like if you can simply gain them very easily. These are very easy topics to gain on, but only thing is we lack information on that. So hope you guys find it useful. Thank you and have a good day. And please like, share, subscribe, follow me on Insta, follow me on LinkedIn. And yeah, just keep getting such updates from me. So yeah, bye guys. Signing off.